Where are we today? And if you're an investor, should you be as reactionary as we've been?
Well, first of all, where are we? That's a very good question. And I think nobody's really sure anymore. When you think about, I mean, you just mentioned it, we came from your president threatening further tariffs to having second thoughts, and now apparently reopening negotiations, which the Chinese don't really know about. So it's entirely unclear. So should the investors be that reactionary? I'm not quite sure it's really the end investors that are driving this. I think there's quite a lot of other participants in the market that react much quicker to headlines. But one of the things that you definitely see, I think, and you see it particularly in the bond market, not so much in the equity market, but particularly in the bond market, is the anticipation of these frictions to not go away that quickly, and therefore ultimately having an impact on the economy. I think they're very clearly visible.
Yeah, as of right now, the 2-year yield is yielding more than the 10-year at this very moment at 1.52%. So there is a fear in the bond market. And of course, we talk a lot about this yield curve inversion, often preceding a recession. Are you fearful that a recession is in the near term for the United States or perhaps other global economies?
Well, first of all, I think we should be separating the US and probably the entire North American continent from the rest of the world, because I think there are very different features here. And when you say, are we fearing a recession, I think fearful is probably a too strong a word. We're certainly mindful of these risks, although we think particularly for North America, it's not imminent at all. However, when you look at other parts of the world, particularly our part here in Europe, there's certainly, I mean, our growth rates are much lower to begin with. The largest economy on the continent of Europe is now flirting with at least recessionary tendencies. The labor market is weakening to some degree, and we have the domestic event of Brexit to contend with. So I think there's a much larger risk over here of at least a pronounced downswing in the economy. That risk is very clear.
So we're talking a lot about risks, uncertainty, worries. If you put it all together, Peter, for an investor, what should you be doing? UBS is recommending basically that investors trim positions and go underweight equities.
Well, I mean, going underweight equities is a risky bet at this stage, because when you see, particularly in North America, that interest rates potentially could come further down. If the economy takes a hit, the interest rates could come further down. And what we do know is that in the early stages, typically, of these economic downswings, when interest rates come down, the equity market does reasonably well, because, of course, the discount function goes down, and therefore the multipliers can still remain relatively elevated. And I think that's what we're seeing currently. So I think my recommendation currently would be to, at the very least, have a sizable proportion still in relatively low-yielding bond markets, I'm afraid.